Hello Apex entrepreneurs and welcome to this video. Today we're going to learn some new tips about how to value a stock. Now, as we mentioned in our last video, investing can be risky if you get emotional about it. That's why in order to make money out of the stock market, you have to understand how to value a stock properly and only buy undervalued stocks. So, in our last video, we learned about two important ratios that help us value a stock: the price to earnings ratio and the PEG ratio. Now, these are very important ratios that you must know before taking any investment decisions. If you haven't watched our previous video yet, click on the link in the upper right corner if you're on PC, or the one in the description if you're on mobile. In this video, we're going to talk about some other important indicators that will help you value your stocks. But before we begin, we have to understand the meaning of the term equity. I know that a lot of you are familiar with what equity means, but for those of you who don't know, equity represents the amount of money that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debt was paid off. We find equity by using this formula: total assets minus total liabilities. So if a company has 5 million in assets and 2 million in liabilities, then the equity is equal to 3 million. Now let's begin with our first indicator, the price to book ratio. This is equal to the price of a share divided by the equity per share. Equity per share is also called the book value per share, and it is equal to the equity divided by the total number of shares. Now, what this means in reality is basically how much money would an investor get per share if we sold the company today. Let's take the example of Apple. The book value of Apple in 2019 was $90.488 billion, and the shares outstanding was 4.443 billion shares. So, to get the book value per share, we take 90.488 divided by 4.443. This gives us $20.37, which means if we wanted to sell Apple right now, for every share you own, you'll get $20.37. The Apple share price on the 17th of January 2020 was $315.24. So this means if you buy a share, you'll pay around $315, but if a company went bankrupt and they wanted to sell it, you'd only get $20.37. Now, if you've already bought some shares in Apple, please don't panic. I'm going to explain why this is fine. And this is where the price-book ratio comes in. We take the share price of $315.24 and divide it by the book value per share of $20.37. This gives us 15.48. This actually means that Apple is worth around 15 times as much as its assets could be sold for. Essentially, the price-to-book ratio, or PB ratio, indicates whether you're paying too much for what would remain if the company went bankrupt immediately. So, a low PB ratio could mean that the stock is undervalued. It could also mean that something is fundamentally wrong with the company, which caused the share price to go down. On the other hand, a high PB ratio could indicate that the company is overvalued. But it could also mean that investors see a great potential in this company. And this might be the case with Apple, which is why you should stop worrying. For example, Tesla's PB ratio in January 2020 was equal to 15, and the price of shares was growing exponentially because investors thought that Tesla had great potential. So, to conclude, the PB ratio is a good indicator and could help us know if a company is undervalued or not. But it is not sufficient, and we have to consider some other factors. Let's move on to another important ratio, which is the return on equity ratio, known as ROE. The return on equity is equal to the net profit divided by the shareholders' equity. The return on equity ratio is often considered as a measure of how effectively management is using a company's assets to create profits. A high return on equity means that the company is very efficient using its assets to generate profits. The higher the return on equity is, the better it is. A good rule of thumb is that an ROE above 15% is considered very good, and an ROE above 20% is considered excellent. An ROE less than 10%, however, is considered bad. In order to be more accurate, we have to compare a stock to other stocks in the same industry. If the average ROE in the industry is 12% and your stock's ROE is 14%, we can conclude that the management of your stock is above the average at using the company's assets to create profits. Let's take a look at the ROE of some famous companies. As at September 2019, Facebook's ROE was 26.66%, Amazon was 15.58%, and Tesla was 9.73%. Now, let's move on to the last ratio we're going to look at today, which is the debt-equity ratio. This one's nice and simple. All we have to do is divide the debt by the shareholders' equity. The lower the debt-to-equity ratio, the better it is. Higher DE ratios tend to indicate a company or stock with higher risk to shareholders. Any DE ratio greater than 2 is considered too risky. For Facebook, the DE ratio is equal to 0.1, which is great. For Google, it's even better at 0.07. In order to value a stock and decide whether to buy or not, you have to examine all of the ratios that we have seen in last week's video and in this video. Also, always remember to compare the numbers of a company to its competitors in the same industry and not to the average S&P 500 numbers. We should also take note that in the last couple of years, we were and still are in a bull market. The majority of stocks are currently overvalued, so it is difficult to find an interesting company to invest in. In a bull market, it's difficult to find value. But in a bear market, you can find a lot of undervalued companies to buy. You should also note that all of these methods might not be efficient in valuing disruptive, high-growth companies like Tesla, for example. Tesla has actually been losing money for the last decade. So if we apply the ratios we have seen in this video, we might conclude that it's very overvalued. But what if Tesla one day succeeded in getting a dominant market share in the automotive industry? Then its share price could potentially surpass $2,000. So when you evaluate growth companies, you should always take into consideration a lot of factors other than just the ratios. And we also have some good news for you. If you've made it this far into the video, it means you are truly interested in making passive income from the comfort of your own couch. That's why we've prepared an hour-long free video course in which we'll tell you about a lot of techniques to help generate at least $2,000 a month, all while sleeping. Of course, this isn't a get-rich-quick method. There is a lot of work to do up front before you can enjoy that money falling into your bank account. All you have to do to watch this free video course is click on the first link you find below in the description. That's it for this video. If you enjoyed it, don't forget to share it with your friends and hit that like button to help us with the YouTube algorithm. Also, don't forget to subscribe and hit that notification bell for more videos like this one. If you're still here enjoying this background music, here are 2 more videos that we think you'll love watching. All you have to do is click on either one of them on the screen right here.